How's it going? So I've been talking for the last 5 minutes. I've been making my way through the class, and I am all by myself today with this recording, and I did not push stream live. So 5 minutes went by before I was like, where is everybody? Why is nobody talking to me? Okay, well, if you're watching this for the first time, welcome to the Doe Show. I screwed up, but I'm going to start over. My name is Dustin Tibbetts. I'm a financial advisor with Jazz Wealth Managers. We manage our own investments. If you have a 401k to roll over, an old 401k, if you're looking to start a new retirement account, if you have another Roth IRA somewhere else and you want to transfer that to a fiduciary who only focuses on you, we build our own portfolios. We have nothing to sell but ourselves. Give us a shot. Check us out at Jazz Wealth. I encourage you to go to the portfolios page on our website and see our funds. Just like you would go somewhere else and they would offer you a mutual fund, but then charge you for it. We have our own funds. We build them ourselves. We're constantly tweaking them. Our performance is on the website so you can see, well, if I were to invest aggressively, would I be okay or whatever? Feel free to check it out because they're our funds. We don't even have to charge you for that. So check us out at jazzwealth.com. I think that's all I said the first time around. Look, on the Doe Show today, we're talking about your investing number. Doesn't have to be for retirement. It could be for anything. But for the most part, people that watch, people that are staying sort of in tune with what we're doing, they're focused on retirement investing. Here's the thing. Really simple for someone to go, 3 years from now, I'd like to buy a house, and I'm going to need $30,000 for a down payment, maybe some closing costs. I've got 3 years, $30,000, divide that by 36, right? And you come up with a monthly number if that's how you want to, go about saving. So that's cool. If you're a little more complicated, you go, well, I want to invest for so long to buy a house or whatever, to send my kids to college. I expect a certain return for that investment. And if I average a certain return, then I end up with X number of dollars. Even that's fairly easy to do. Where we get really complicated is when we say, when I retire, I'd like to have a certain income. Look, I'm used to making X number of dollars a year. Let's say you make $65,000 a year. You go, well, I'd like to make $55,000 a year in retirement or something. So because of that, it gets a little more complicated. Now, if you're paying attention or if you just dozed off for a second, now is the time to pay attention. Please don't leave a comment on this video or any of the other ones saying, Dustin, I'm 40 years old. How much do I invest for retirement? I can't help you. I'm sorry, right? I can't offer that assistance to you if you're not one of our customers. Number one, I can't put the time into it. But number two, I don't know you, right? There are variables to consider. When someone says, I'm 40 something, how much do I put away for retirement? My mind goes, well, I want to help you, but what is 40 something? Is that 43? Is it 47? Are you being honest with yourself and you're really 49, right? What is the age? When do you want to retire? What age? What tax bracket are you in? How much have you already saved for retirement? How much is in your 401k that you contribute to on a regular basis? You see what I'm saying? What tax bracket do you expect to be in retirement? What account do you use primarily to save for your retirement? And so we need to answer those questions. Are you one that expects Social Security? And if so, how much do you expect? Do you believe that inflation is this number or this number? So those are the kind of things that I'll work through with our clients, right? I'm happy to do that for any one of them. A lot of them like to do it fairly regularly just to sort of check in or when their life changes a little bit, and that's totally okay. So I just want you to pay attention because I can't answer those questions if you're not one of our customers. So I always try to politely say, we need more or we need to know the variables. I'm sorry, I feel bad, right? Because I really want to give you the answer. I think it would help you and it may even convince you to come this way. But I just can't, right? So careful when you leave the comments. Also, please don't email me and say, I'm not one of your customers, but here's all my variables. I'm not allowed to respond. Everything is double and triple checked by Mr. S, E, and C over there. So I have to be careful. So what I want to do today, I want to give you the variables. If you want to figure out how much you should save for retirement, and Jazz Wealth is just not somebody that you need to work with, totally cool. I appreciate you watching. But I want to give you the variables so you could start to work these numbers through yourself, okay? So I had all this written down and everything. I want to know, how much have you already saved for retirement, right? That's the first one. Where are we starting? What are we starting with? Do we have a 401? Let me do it this way. How much have you already saved, right? Do we have a 401k at work, do we? Do you have a 403B or 457? Do you have a Roth already? Do you have a SEP IRA? Right? Do you have accounts that you're just investing in and hoping for the best? That's what we're starting with. Some people, believe it or not, come to me and go, Dustin, I've been saving for retirement for 9 years, 8 years, 3 years, but I haven't seen any growth. And it's interesting because as you start to dig a little bit, you find out they've just been putting their money in a savings account. They didn't know any better, and so it becomes sort of an educational piece there. Either way, whatever you have already saved for retirement, we want to factor that in. I'm going to work through a model here. I've already done some assumptions for us, but I'm going to work through a model that says this number, so we can come up with a number. I'm going to assume someone has all of these accounts and they've saved up $40,000 between a 401k, maybe a Roth, and some little savings or whatever, okay? That's the first thing. The next thing, how much do you want in retirement? How much do you need, right? Is the answer that you want $50,000 a year? In today's terms, by the way, is it $65,000 a year? Do you not know and you want to take a shot with a couple numbers just to see how scary it gets? We could say $1 million a year if you want. You're not going to be happy when you see how much you have to put away, right? So that's the question, right? How much of a yearly salary do you want? I do yearly because it's easy for someone to say, well, I make 55 now, and so let's shoot for that. You understand what $55,000 a year buys you. If you go, well, I make $85,000 a year now, let's shoot for somewhere in between. It's easy because in today's terms, you can understand what that buys. Understand that inflation 30 years from now, whatever that number is, let's say 85,000, let's say in the future it's $133,000, it's still going to buy the same thing that you could buy today with 85,000. So we back it down, right? We want to figure out what to buy, what to do in retirement. We're going to say, for this example here, I'm going to go $50,000 on my little calculator here. Okay, now next thing, next variable you need, other income. What other income do you expect? Any? A lot of you have rental properties. A lot of you have dreams of getting rental properties, right? And having at least a little something there where someone pays you rent. This could be rental properties, Social Security, that's what that is. Social Security, it could be royalties from a business, right? A lot of people sell their businesses as they get older. They may not get a cash payment. They may get royalties or something over the years. Maybe you sold a patent or some portion of your business. Very popular. So other income, what is that going to be? Now this is in future dollars. You're going to sort of predict out in the future. Don't do today's dollars. I'm going to put in, I don't know, $20,000 a year. And we'll assume that that is Social Security, some rental income, right? It's probably going to be higher than that, but let's underestimate. Anytime you factor your future income in retirement, the extra stuff, go a little bit lower. If a guy gets $1,000 a month for a rental property and that's his take-home profit, then that's pretty low, assuming from, a long time from now. So that's $12,000 a year. If Social Security pays out a little something, that's a little more, so we'll use $20,000 for our calculation. Now, the next thing you want to know is, will the other money get taxed? Does this stuff get taxed? Of course it gets taxed, right? Your rental income, your royalties, right? You know that is going to get taxed. So you're just going to say, yeah, I need to assume it's going to get taxed. What tax bracket does it get taxed at? That's a good question, right? We have to make some assumptions here, right? So we have to assume that in retirement, taxes will be higher. Let's overestimate. I like to use 28%, okay? Now the next thing you want to know is, what is your current tax bracket? What is your current tax bracket now, right? What is it? And for most of you, you're younger, you're in that 22, maybe 24% tax bracket for 2018. So you just want to know, where are you at? You 22? Oh, shoot. I suck at this. Are you 24? Are you below that, right? Are you down in the 12%? Where are you? For my example, I'm going to use 22%, nice right in the middle of the road there, okay? Now, the next question. You'll know this already, but I have to ask you at some point. How old are you? What's your current age now? Okay? I'm 30, how old am I? I'm 36. No? I think I'm 36. So, yeah. Anyways, I'm old. So we're going to use a 32-year-old, okay? So let's say you're 32 years old. A lot of you are younger watching this thing. That's cool, okay? You're 32 now. That's what we'll use in our study here. What age do you want to retire? Now, this is where most people go, shoot, I don't know, right? When can I retire? This is sort of a guess. If you're 32 years old, you really don't know. And you're not supposed to know, by the way. So this is where people go, I don't know, how about 65, 67? I don't know. Let's start with that. Totally okay. Remember, these are variables. Some of you are going to have different tax brackets, of course. You're not going to know maybe how much you need in retirement. Take a shot, right? If you're going to do the math, take a shot. All right. Inflation. If you get a chance, factor in inflation, okay? You can go low if you want. You can go high. The average, I believe, is 3.4%. You can use whatever you like. I'm going to go high on this one because you guys beat me to death in the comment section if I don't include a high enough inflation. I'm going to go 3.4%. I don't care if you think the world is coming to an end and inflation is going to 10%. And you go, well, look what happened in Turkey over there. That's crazy. That doesn't matter. That you can't plan for extremes. You got to plan for what you kind of see as an average there. We're going to use retirement age of 67. We'll change it in a minute to see what 65 looks like. Now, expected returns. I'm out of room, so we'll go with that. What do you expect to make on your investments? This is why it's so hard for me to generally throw out numbers for you, because I don't know how this, what you already have saved, is invested. If you're one of our customers, I can easily go, oh, you're in our too aggressive funds? Gotcha, no problem, right? But if you have a 401k at work, I'm not going to go through that for you. If you're one of our customers, I'm going to say, hey, if you know, tell me what you have in your 401k and how it's invested. Are you aggressive in that 401k? And if you don't know, would you send me a statement real quick so I could dig through and see how you're invested? That's going to allow me to come up with a very, very fine expectation for returns. I'm going to use 7% today just as a default. Most people use 7%. Okay? Now, the last thing you want to do is go, what is my primary savings account? Is it the 401k? Do they have a big match and you put the most of your money in there? Cool. Know that that money's getting taxed. If it's a regular 401k, when the money comes out, it's getting taxed. So very important that you factor in that tax rate like we talked about. Tax bracket, the tax you expect to pay, right? So factor that in. Here's what we come up with. With our study here that we've done, while I gave you all the variables to sort of factor in there, with our study, we plugged in our numbers there. Like I said, I got a head start here. I beat you to the punch a little bit. So, to be a 32-year-old with $40,000 already saved up, $20,000 expected in extra income, you're 32, you want to retire at 67, we'll use that as an example, and 7% returns with 3.4% inflation. Did I lose you yet? Is it too much? Assuming the 22% tax bracket, I don't know, we'll just put it in here somewhere so you know. 22% tax bracket now, so if you're contributing to a Roth version of something, then which we're using Roth IRA as our example, right? You got 28% in future taxes. You get what I'm going with now. So if that's the case, and you wanted the $50,000 in retirement, given everything factored in, if you want $50,000, then you need to save, I don't know if anybody fits this criteria today, but if you do, I'm giving you essentially a free number. If you want $50,000 a year in the future, of course the number is going to be a different number, but you need 54, 30, 90. You need to save that in your account. So if it's a Roth IRA, good news, you can put that much in a retirement account. If it happens to be your 401k, let's hope your employer matches some of that contribution. That means you put in even less. Now, that's for $50,000 at 67 years old. If we change this now, so 22, let's say retire at 67. If you want to retire at 65, you know the number is going to be higher, right? How much higher? Can you retire sooner than expected? Let's take a look here. 65, you're at 67.27. 38. Cool. Let's go even more geeky about it though. Let's say this is your number. Okay, I could do 67, 27, 38. You will have put in a total of $284,619 in today's dollars. Right? So it took $284,000 of your money to end up with 1,643,935 in retirement. That's going to be your balance, right? So you put in 284 in today's dollars. Overall, it's going to be 510,000 if you account for inflation. Your ending balance is going to be $1.64395 million, which will allow you to withdraw $50,000 a year in income, factoring in, everything that you have, right? That's pretty cool, right? I think it's pretty cool. So that's what you're going to end up with. Now, from there, you can say, great, how much is that every month? Let's say you want to retire at 67. So it's 54, 30, 90, and let's say you've got all year. So it's $452 a month. So let's hope your 401k maybe contributes a little bit a month. Or it's, what's the number again? 543090. 104.44 every week. And I'll give you a little hint. That's the number you want to go for. We've done some great studies to show that if you do weekly over monthly, you end up with a much better number in the end. Because think about it. Yesterday the stock market fell. Today it recovered all of it. What a day, by the way. We'll talk about that later. But there are going to be times where during the week the market falls, your deposit hits, you buy cheaper. Then the market goes up, you buy a little more expensive. The market falls for a couple weeks, you buy cheaper. If you're only buying once a month like everybody else, then you're relying on one price for the entire month to spend all your money. We don't charge you any more or anything to do it weekly, so we say do it weekly because we find that all you have to do is change the duration, right? Smaller amount and the duration, you end up with more money in the end, and all you had to do is contribute a little different. Perfect. Okay, so that's all I got for you there. That's where we're at. So if you have any questions, I will be happy to answer. Do you help manage with recommendations on college funding? We do custodial accounts here, not 529s. We do custodial accounts. So yes, we can invest them in our funds and divide them up and invest as aggressively as you like or as conservatively as you like. Kevin says he's 34. You want to retire at 70. You know, a lot of the younger kids, even myself, I'm like, what would I do? I would just probably trade all day, So that's not really retiring because I'd set up a business again. What does retiring mean? To me, I don't really feel like I'd stop. Now, we're young, right? So there's going to come a time where we get a little tired. We want to slow down. Felix is 27, has about 30,000 saved up. Good job. So already looking good. That 65 number or 65 age for you is going to be good. 80,000 with inflation. I'm not sure what we said. Our number figures inflation. So you want 50,000 a year in today's terms. The actual number is factored for inflation going forward. This number is with inflation, right? So in the end, yes, we are factoring it in. 12% of your income. Good job, Kevin. Good job. How much is $5,500 yearly into a Roth IRA for 30 years with a 7% return? That's a piece of cake. It's not the number I would run for you, but that's as simple as just going retirement calculator and putting in $5,500 each year. Do a compound interest calculator. I think Google Sheets even probably has a simple one there. 33, want to retire in your 40s. Is it going to happen? Oh, he's saying it's going to happen. Good job, financial investor. You're thinking about building. So Justin's saying, I'm 35, 80,000 in my 401k, thinking about adding a Roth to the mix and maxing out either the 51. Always the 401k up to the match. If you have the ability to go beyond that and still do the Roth, of course, nobody's ever going to tell you not to do that. Perfect. Max out the Roth for sure. I reschedule weekly investments on Mondays, best read day. Interesting. We did a study on all 5 days to see not only all 5 days, but all 5 days on the open, on the close, and at 12 o'clock Eastern time. Just to see. I did that a long time ago. I think we did shoot, it was probably around last Christmas when I did that video. It's Dustin, by the way, but I'll take that. Oh, he's talking to Justin. No problem. Yeah, I guess. I don't know, man. We'll see how the Cowboys are doing, Kevin. Definitely want to look into a Roth 401k and Roth IRA. Yep, good advice. Sounds good. How much is a personal quote like this from you? I want to do a personal situation. Yeah, I don't. That's not right. I wouldn't charge for something like that. I would say it's not crazy to figure that out. We're not really like planners. I've thought about adding that. The problem is we're not licensed in that category, so I can't call myself a financial planner. Just like I can't help with insurance. You notice how there's no insurance videos. While I may be able to advise you on the advisor side, the rules are pretty clear about what I can and can't say regarding stuff I'm not even registered to say, so tough one. So that's it. There you go. Do you have to increase that contribution? Yes. So Justin, good question, by the way. I missed that. So Justin's saying you got your 54, 30, 90. That can't possibly be every year, right? Because inflation's creeping in. So in our study that we just did, this number goes higher. You're going to add 3.4% each year to that, right? That's what we decided on our inflation number. If you believe inflation's going to be higher, you add whatever you think inflation's going to be. If you're one of those Alex Jones guys and you're like, yeah, inflation's going to be like 50% for the rest of our lives, I mean, everybody's entitled to their opinion, I guess, but change that number to 50% if that's what you believe. Same for this one, right? This is going to be the same, adjust for inflation. Thank you so much for pointing that out because I didn't mention that. You got it. You got it. You got it. Love it, love it, love it, guys. Okay, well, I was hoping to make that short. It was a little longer because I ended up doing this video almost twice. That's all my bad. I'm just here, doing my thing by myself with this stuff today. So, anyways, have a great rest of your day. The stock market. Did I not tell you yesterday? I'm not one of those I told you so guys, but didn't we say yesterday that China was not slowing and that they would figure that out? I got some very, very good quotes from Overnight Media, the guys that in Bloomberg Worldwide that actually cover this stuff to explain exactly what I told you on the Doe Show or on the Closing Beat yesterday. So stay tuned for the Closing Beat later. We're going to review it and explain why you have to look deeper into the news. Never watch a headline. You do not take action off of a headline at the bottom of anything. You are being misled. And I'm not a conspiracy theorist. I'm saying they had it wrong. I pointed it out in yesterday's video, so take a second, watch yesterday's video so you can prepare for the Closing Beat today. I will be back at 5 o'clock, of course, to cover all of it. We'll review it if you don't have a chance to watch that beautiful video from yesterday. And see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.